Last week has been terrible for stocks. Over $2 trillion was wiped out of the stock market in just 4 trading days. It was absolutely crazy. And in my personal opinion, this is the time to be looking for stocks to buy, to add to my watch list, close to my fair value. This is the time to be maybe averaging down on some stocks, buying stocks, looking at different opportunities. And this is an amazing quote that I retweeted. I just want to say it. And it says, in bull markets, investors only see opportunity and are blind to the risk. In bear markets, investors only see risks and are blind to opportunities. I'm not saying that we are in a bear market right now or a bull market or anything too extreme, but all I'm trying to say is most people on Twitter are saying, I'm not buying stocks because we're going to have a recession and because stocks are going lower. They're forgetting the opportunities and they're looking for risks. And this is what most investors are looking at, but they don't know that the market is forward looking. And by the time the recession comes in, if it ever does come in, stocks we might have priced in a lot of that stuff and they would be going much, much higher when no one's expecting them to. So no one's going to be able to time the bottom. And in this video, I'm going to discuss 3 stocks that I believe are one of the best buying opportunities right now. Some of them are at fair value. One of them is undervalued. I'm going to discuss the first one. It's going to be an amazing stock I haven't discussed in a while. And then I'm going to get in the other two. Okay. And the first stock is LVMH. Ticker symbol LVMUY. I first bought this stock in February. I sold it in 2 months. I made like 29% in 2 months. It was a massive, massive rally back then. And this is was here from January to February. It was a massive rally and it was pretty quick. But now the stock is down over 26.5% over the last 6 months, mainly because of recession fears that we're going to have a recession and a lot of slowdown in China too, and mainly in Asia, excluding Japan. And it's a lot of slowdown and recession fears. They're pushing the stock down so much that LVMH is now trading at 19 times earnings. And if you look on a historical chart of the forward multiple, 19 times earnings has historically been an amazing time to be buying LVMH. This is where it bottomed in March 2020. This is where it bottomed when I bought it. Then I made 27 or was 29%. I shared a screenshot in 2 months. And this has bottomed there many times. And now it's trading at 19 times earnings. And you still have investors not interested because we could have recession stocks going lower. But I'm going to talk about this risk at the end of the first segment. But a lot of you are familiar with LVMH. They own very popular brands. I mean, one of the most popular luxury kind of higher end brands all over the world. It's a pretty amazing company, a lot of brands, a lot of diversification in this company. For the first half, revenue was still up 2%. Which was extremely surprising because a lot of the luxury stocks and stuff, they're declining, but LVMH still has some kind of a branding power. A lot of people love that stuff and they're willing to pay up for a lot of the stuff that LVMH actually sells. In terms of profit from recurring operations, it was down 8%, but revenue was still held up 2%. And I was impressed. It wasn't bad at all. In terms of perfumes and cosmetics, this has been one of their strongest category, around 3% in terms of revenue or 6% organic. The weakest one, which has been the weakest for most of them, is mainly in terms of wine and spirits. A lot of the alcohol stocks, they've been suffering. You could look at a chart of DEO and a lot of the other alcohol stocks. They've been crashing like crazy and it's been pulling back a lot. And they have very bad long-term fundamentals from younger people trying different things other than alcohol. So that's something to think about. But in the short term, a lot of them are pricing in a lot of fear. That's all I can say. But LVMH's wine division declined 26% in profits from recurring operation. It was pretty bad. Most of their sales come from Asia, and this is where the slowdown has been, especially in China. A lot of people told me on Twitter, which is a very smart way to think about it, is that the best way to bet on some kind of a China recovery or Asia recovery is to bet with LVMH. If you don't like Chinese stocks, you could buy LVMH, and in this way, you're kind of betting on a recovery in China. And that was a very smart way to think about it. But in terms of growth in general, the United States was 2%. This is what it's historically been, 1 to 2%. Japan has been a beast for them, up 44%. Asia, excluding Japan, was the weakest one. As I said, it's down 10%, but it improved from the previous half of 14. Now it's at 10%. Europe, almost 3 to 4%. It was 3%. It wasn't the best. Now we're talking about LVMH. And one major problems that I see in the short term with the company is analysts, in my opinion, they're still extremely bullish about the earnings of LVMH. I mean, I would highly doubt that in 2024 and all the stuff that's happening, and we are having a weaker economy. I mean, this is just the truth, but especially in the United States. Now, you have to keep in mind that this company is global, and the United States only makes up 25% of the revenues. So maybe analysts end up being right because they have some kind of a branding power, but the analysts only expect a decline of 1% in EPS. I mean, I don't know if I believe that, guys. I mean, I would expect something a little bit worse for a year like 2024, especially if you compare it to different retailers and different companies that are comparable to LVMH. I would expect at least -8%, -10%, in my opinion, which makes me believe there could be a little bit of a downside on the multiple, meaning, yes, the multiple is at 19 times earnings, but if EPS gets revised from -1% to -10%, then maybe this PE is closer to 21 than it is closer to 19. And even 2021 isn't really too expensive for a quality company over the very long term. And if they decline 1 to say 8% or 10% over the next few years, they're likely going to grow again because of the company, around 10% for 2025, around 10, 11% on average. And they have a decent dividend, which is not the best. So this is the kind of returns I would expect from LVMH. But the best way, in my opinion, to look at it is if they do report earnings in the next few months and they revise guidance in terms of analysts from -1% to -8%, I mean, that would be like a generational bottom on something like LVMH, because 2025 is going to be better than 2024. You're likely going to get to 10, 12% returns, annual return from LVMH, but you could also get a potential multiple expansion if you were able to buy in much, in my opinion, after the earnings revision, around 19 times earnings. The company went as high as 26 times and it traded as high as 40 times, as low as 16, and here you're buying it at 19 times earnings. So in my opinion, over the next 3 years, there's more upside than downside buying LVMH at this price. And this was my quick overview on the company, and it's on my watch list, and I'm interested in buying it again. The second one, which I talked about so much, and that's going to be very quick reviews on these stocks, and this is Amazon. Amazon has held up better than most companies or most stocks this year, but it's down around 3% over the last 6 months, nothing too crazy. And I found this interesting chart that shows you how Amazon make money from Amazon online, the physical stores. Then they have the subscription, they have the advertising on Twitch and Amazon advertising. Then they have Amazon Web Services, and you could save it or you could go to App Economy Insights. It's a pretty amazing Twitter account, and it gives you how companies make money and where the expenses go. And it's a pretty good chart. This is another one of the cloud infrastructure market share. AWS is still king at 32% market share. Then you have Microsoft Azure, which has been rapidly growing, 23%. Then you have Google Cloud at 12%, and then Alibaba, which was around 3 to 4%, now sitting at 4%. You look at AWS revenue growth, it has been increasing. It bottomed around 12%, then 13, then 17. As of the last quarter, it was 19% year on year. And this is very encouraging in terms of the growth picking back up for Amazon Web Services. But Amazon is much more than Amazon Web Services. They have just so many different potential in terms of AI and many different places, but mainly in terms of Prime, in my opinion, mainly Prime Video. And this is a recent news. And they did win an NBA deal, by the way. But it says Amazon is nearing a deal to broadcast NBA, MLB, NHL games on Prime. So that's going to be a game changer. And they're trying to monetize Prime. Advertising is going to be huge for them. I talked about it a lot, so I'm not going to talk about it again. But if you look at the multiple of Amazon, it's sitting at 32 times free cash flow. And 32 times free cash flow isn't, maybe the cheapest multiple ever, I would say. It's especially if you compare stock-based compensation. But if you look at the growth of the free cash flow, the Amazon has been experiencing, this year they grow free cash flow 48%, then around 31% in 2025, expected 32% in 2026. And I believe those numbers because now Amazon is more focused on profitability than just putting in heavy capex on investments. This cycle is over, and this is a cycle of profitability and free cash flow, and I believe it, and it's been happening even from 2023, 2022. It's been happening, and in my opinion, it's going to continue. But if they can sustain it around 32% over the next 2 years, you're pretty much paying one-time free cash flow growth. One-time free cash flow growth for an amazing company like Amazon with a good balance sheet, all that stuff is extremely undervalued. And I did mention that I'm expecting a double over the next 5 years for Amazon, or around 15% a year over the next 5 years with the company. This is the second best stock that I believe is a good buying opportunity right now in terms of the quality stocks. The third one is Google. Google is down 7% over the last 5 trading days. This is another one of how Google makes money from YouTube, Google search, advertising, and Google Play, Google Cloud. And it's, again, another amazing chart that shows you that stuff. Google Cloud wasn't profitable. The company finally turned it profitable, and it's been profitable for around 6 quarters right now, and it's improving over time, and it's very encouraging for Google. Now, if you look at where Google is priced at, it's priced at 18.8 times earnings. And this is what I have to talk about. The lowest I traded at was 16.7, and now it's trading around 18 times earnings, one of the lowest it has traded at. But you have a lot of people saying it's because of, ChatGPT is taking market share. Maybe because of the antitrust stuff. And maybe because of other things with Google, that it's losing its moat and all these things. But all these things are true. But it's all about what's being priced in the company. It's all about how much we're paying for the company, because a lot of that stuff could be priced in the company. And the question is 18 times earnings for a company like Google expensive? For a company that has 28% return on capital, for a company that has around 100 billion in cash and only 11.8 billion in long-term debt, for a company that grows this year in terms of earnings, I believe it's around 31%, and it's expected to grow 13 to 14% over the next 5 years. And in my opinion, it's easily achievable for a company that has Google. I mean, even though you're going to have ChatGPT and other stuff, you still have Google. For YouTube, you think 18 times earnings is expensive for that stuff? In my opinion, it's not expensive at all, which leads me to believe that everyone is right about all these risks, that ChatGPT could take market share from Google over the long term, that it has a lot of competition, of the uncertainty of the antitrust stuff, which in my opinion the biggest risk, because we don't know what's it really going to be. But it's for sure going to save $20 billion for Google that is paying Apple every year. I mean, and YouTube is still there, so that's how I think about it. But 18 times earnings for that stuff, a lot of it is priced in. And in my opinion, Google is another one that I believe is presenting a great buying opportunity here. But whenever a stock goes down, we start trying to find reasons why not to buy it, why it's going lower, because we're scared of buying it and losing money. And then when the stock goes back up, we look in hindsight, we say, oh, it was obvious. I wish I bought Google. I wish I bought Amazon. I wish I did this. I wish I did that. And this is how the market works. It's never going to bottom when it's obvious, whenever you feel it's easy to buy. It always bottoms when it's not easy to buy, whenever there's uncertainty. But looking at the valuations of Google, LVMH, and Amazon, I think if anyone is buying them here over the next 5 years, I think they will look very good. And it doesn't mean these stocks can't go lower. But the best way I personally do it is I buy and then buy a little bit more later, so I slowly dollar cost average down, because no one's going to be able to time the bottom. And that's how I think about it. So that's my opinion on those 3 stocks. Not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.